Hello, in this lecture we're going to continue on Behavioral Economics and Modern Economic Policy, Chapter 22. Remember, the objectives are to explain the relationship between behavioral economic policy and mechanism design, define nudge and choice architecture, and explain how they are related to behavioral economic policy, discuss the problems of implementing nudges and how the behavioral economic frame changes how policy is viewed, and discuss the concerns many traditional economists have about nudge and push policies. Okay, so we talked about nudge policies last time. We're going to continue on with distinguishing a nudge from a push. So if government can institute a behavioral economic policy directly, or if a private firm chooses to implement a policy of its own, it's a nudge. So that's going to be a nudge if we're able to implement the policy on our own, whether we be the government and or a company trying to implement a policy. And again, the policy is in there in terms to try to influence someone in terms of their behavioral outcomes so that we have a system that will achieve a goal that we are trying to achieve. So a government has to develop a regulation and requires firms to implement a particular nudge. It's a push. So when we think about the government putting in a policy, if they're requiring a firm to do so, then basically they're kind of pushing the firm in order to nudge the employees. And we can see this happen a lot of times, and that of course is the critique many times in terms of these types of policies that could be implemented. So for example, there's a healthcare law that could try to implement healthcare to try to influence whether employees have healthcare or not. We know that a lot of tax laws are going to be implemented in terms of, one, trying to incentivize people to have retirement plans. The tax laws just traditionally in terms of the tax law basically require the employer to withhold from the employees. So we're basically requiring employers to incentivize or force the employees to at least pay some of the federal income tax. And notice traditionally the federal income tax responsibility, our responsibility as a citizen, is to pay our own taxes. And we're clearly making policies in terms of tax policy to require the employer to take an active role in making sure that the employee pays their taxes, or at least is aware of the taxes, more likely to pay their taxes or more of them. A push policy is a regulatory or tax policy to get firms or individuals to use appropriate nudges. So we're trying to force, obviously through regulation, the companies to nudge the employees. So behavioral and traditional economic policy frames. So if we think about the frames of our traditional economics versus the behavioral economics and when we should and could expand those frames, we have the traditional economic desires are inherent to each person. And so that's going to be in our traditional model. We're going to say basically the desires of each person are inherent within the person, versus behavioral economics, desires are affected by context. So we have to expand that in some cases. We know in observation that it's not just that we're not influenced by society or other conditions around us. We know that that desires are affected by the context. Now again, that doesn't mean that the traditional model is gone, we need to throw it out the window, and now we're moving on to the new model. The point of a model is that we are eliminating a lot of factors in order to see the cause and effect of some factors. And the traditional model tries to do that and is effective in a lot of different cases. When we go to more complex models or take the model into different areas, then of course once something becomes material, once other factors become material in different areas, we need to take that into the model. We need to somehow make the model account for those different circumstances. So the traditional model having more makes people happier. So the traditional model being the idea that the traditional assumption is that we have unlimited wants basically, and we have a limited amount of resources. That's the definition of scarcity. And on the behavioral side, we know that having more than other people is what makes people happy. So we've tested this in many areas. And again, the traditional assumption is applicable in a lot of ways because it can create a graph that can tell us specific things. And when we take into consideration the behavioral economics, we want to take into consideration the fact that people don't react necessarily obviously in a vacuum. They act in relation to other people, and that could take more or less significance depending on what type of thing we are looking at. And when we think that people react to other people, like there's been tests basically, if someone earns $50,000 and we ask them, would they be happy if they earned $80,000? of course, they generally would say, yeah, that would be great. But if we said, if you earned 80,000 tomorrow and everybody that worked around you earned 100,000, then a lot of times people would actually say, well, they would be less happy in that condition, even though they're better off than they are now. And notice that takes in again to account again the social context, the context that people think that they're being treated unfairly in relation to the other people around them, and that's what's creating the environment. So when those effects are taking effect, we need to try to include that in the model, which of course creates a more somewhat complex model, which can be harder to draw conclusions from in some cases. Concerns about behavioral economic policies. So traditional economists have expressed serious misgivings about behavioral economic policies. So notice that this is a tool that can be used when we talk about behavioral economics, and clearly it's used by businesses. But again, the businesses, we all know that the business is there to create profit, and they're going to use whatever tool is there. It gets a little bit more sticky when we put these kind of policies into the government arena, because the government arena is there to represent the people. So there's kind of questions in terms of government policy, how much these ideas should be used on a bigger scale. So the few policies meet the libertarian paternalistic criteria, meaning that a lot of times when we think about the idea of the government putting in a policy, notice what they're trying to do is a few group of people, the people that are in power, basically saying we want to incentivize people to do this by putting in paternalistic policies, meaning policies that incentivize people to do things that the people in power think should be done. And there's question in terms of any time you create a law that you're basically doing a push, not a nudge, meaning that if the law is incentivizing companies to do things that you're kind of it might be considered that we're stepping into the market more than we should be stepping into the market, that we're basically forcing the market to do things instead of incentivizing the market to do things, meaning we're somehow, we could be removing the actual choice from the market instead of just giving people a nudge towards what we think would be a more favorable choice. Designing helpful policies is complicated. And clearly this is the case. When we think about a classical model, or when we think about normal economics, the idea is to let the invisible hand do for itself, and basically that part of that is simplicity, meaning that we're not going to go in there and kind of manipulate the market too much. When we think about going in there and kind of manipulating the market, there's a couple problems. One, when we expand the model to include all these different factors, the model becomes very, very complicated, and there's going to be obviously disagreements on the effectiveness of the model once it gets there. And two, the model is going to be created by the economists, and the people that make policy are going to be the politicians. So now you've got the question of, well, how do the economists get that policy to the policymakers, and then the policymakers then need to implement it. And there's a question of how is it going to be implemented, or how is it going to run through that implementation process, which could distort the policy in ways that were unintended. And of course, once it goes through the political system, people might have self-interest by that point. So by the time it goes from the creation of a very complex policy that might be controversial on the front end to the policymakers to implementing the policy and going through the self-interest of individuals who are implementing it, there could be problems in that process. It isn't clear that government knows better. And this idea is basically inherent in economics, because the idea of economics, the foundation idea a lot of times, is that the market has been more efficient than an elite group of people deciding things like what should be produced and how much should be produced. That's led to so much advances that just that idea of letting the markets work, that when we get to the idea of making significant influence into the market or stepping into the market, there's always this idea of, well, how is it that the small group of individuals knows better than the market? And there's kind of some ideas could be, well, is it really true that the small group of individuals know better, or is there self-interest in the small group of individuals to interfere with the market? So there's always kind of some skepticism. We know that many times people with good intentions, or policies that have had good intentions, have been very well argued that have been harmful when they've been put in practice. We've talked about some of those policies earlier. So when we do go into the market, there are reasons to go into the market that we've talked about, externalities and things like that, that we think that it is appropriate to go into the market. And there's a lot of debate in terms of when it is appropriate to go into the market. Will we do better going into the market? There's also an argument that goes back to this paternalism argument, and that is that if we thought of the government basically as a parental role, and they're trying to implement policies for the individuals, the citizens, to make the best choices that they think they should make, and say some of those choices are things like, we don't want people to smoke and we want people to save for retirement, for example. If we were to ask citizens, do you smoke and do you save for retirement? And they say, no, we don't smoke, and yes, we save for retirement. And then we ask them, why do you not smoke and save for retirement? If their answer is something like, well, because the government told me so, or because it was the default option, that answer might not be that fulfilling to many parents. And if they said, on the other hand, they don't smoke and they save for retirement, you ask them, why do you not smoke and save for retirement? And they said, well, I've looked at the research on smoking and I think it's bad for me, and I think it would be bad for myself and the people around me, so I've made a conscious choice not to do that. And I save for retirement because I want to live well during retirement. I know that I'm going to have to save in order to do that, and I don't want to be a burden on society at that time. From a paternalistic standpoint, it would be, most parents would think, well, answer B is far better than answer A. And there's a question in terms of, do we want a society basically that has free-thinking people making the decision? Do we want to have the decision and say, here's the pros, here's the cons, and it's up to you to make the decision, and trust the people to make the decision, and trust them to make the best decision given the most information? Or do we think the outcome of the decision, things like retirement and choosing to smoke and treating their health care, would be better off even if they do it without knowing why they do it, even if they do it just on a default? Is something to kind of think about when we think about this kind of behavioral nudging.